Let me quickly go over where time becomes a factor, and then we'll go into price because it's always time first, then price. So today, I want to kind of like break down something real quick. I was in the full mini, not the micro today, and we're going to take a look at this little area right over here because that's the opening gap. So it's the regular trading hours opening range gap. So between that candlestick's close and that candlestick's opening price right there, that's today's opening range gap. So what we can do is we can anticipate, obviously, the continuation to the upside. Okay, so the upside is likely to be the draw. But as I showed earlier, using the micros, using a 30-second chart, you can get yourself a little bread and butter set up because the market created that little news event at 8:30 where the micro went down precipitously, but the mini didn't do it. So I indicated on X this morning on my feed that whenever the market does that, what it generally does, it wants to redeliver that, and it'll go back down, or in deference, if it was a market move that went higher, it'll repeat that same price run. So both the micro and the mini can capitalize on that delivery and price action. But it doesn't just overlap that, it goes to it, through it, and operates as a stop hunt. The delivery this morning was a rerun lower to take out the low that was created on that spike on the micro. And because it was done only in the micro, the mini was afforded the opportunity to ride down again with, well, not again, let the micro ride down again, take out the low at 8:30, and then the mini was allowed to trade lower. Okay, so what it did was it traded lower and took all of the short-term little sell side liquidity out, primed everyone to anticipate it going lower, and then obviously extrapolate to the upside. So let me quickly go over where time becomes a factor, and then we'll go into price because it's always time first, then price. Okay. So at 9:30, we'll use a couple vertical lines here, and I'll keep it very simple, straight to the point. At 9:30, we opened here. Okay. And I taught you that 11:30 a.m. Eastern time starts without fail. It will always start at 11:30. It can start sooner. Okay. So after 1 hour trading, your first hour's dealing range, once that's done, certain days, certain um, daily schematics. I don't want to say profile because you guys are going to think I'm trading market profile when I have no faith in that stuff. Let's take a look at the aspect of now, since we have time out of the way. Now, think about the multiplication analogy or the multiplication table. Okay. Close your eyes for a second. Don't worry, I'm not going to get freaky. Imagine the vertical axis and the horizontal axis of a multiplication table. Top of the upper left, it's 1 for the vertical axis, and for the horizontal axis, it's 1. So you would meet going down and to the right, and you would see 1 times 1 is 1. And then you go down the series of multiplication numbers from 1 down to however large your multiplication table is. In the United States, we generally used one that went up to 12. So it's like 1 to 12. So envision, if you will, the canvas of price action where there's nothing on your chart except for now you just have just that opening tick right here at 9:30. Now I'm going to remove this vertical line just to show you in deference to where we are here with these vertical lines and the New York lunch. And what I'm going to show you here is not found in anything else. And I have to say that because you're going to start seeing people try to use this stuff and they're going to come up with all these different ways of describing something. And I'm admittedly holding a few things back because it will be in written format, but then I'm going to come right back out and teach it. So don't buy my books. Okay. I'm reminding you, you don't need to buy my books. Okay. It's not for me to make money. It's for me to simply encapsulate it in written tome. So that way, this is my definition of my own work. This is my life's work. None of you have the right to ever pretend that you know it because you don't. And I'm going to teach it here on this channel, but for people that want to have it in text format and straight by this, do this, don't do this, look for this, that's the purpose of the book. It's if you went through the entirety of the compendium on my YouTube channel, what should you do? Where do you place it? Now, that's not going to save you. It's not, no, in other words, don't look at it and say, well, I'm just going to wait for the books. I'm not going to watch your videos, because you're not going to be able to see a lot of the things that static charts and static examples can't really adequately describe. Okay. Now, this just happens to be one of those things that in chart form, static, it can be accomplished. So right away, we already have the day divided relative to time. We have the opening at 9:30. Then we have the New York lunch beginning at 11:30 Eastern time. If you're around the world in different locations, um, always have your chart set to New York local time. If you do that, a lot of the confusion and things that you see me talk about, or the moves that you don't see happening and they just spring out of nowhere, it's because you're not looking at it through New York local time. So let's take a look at this opening range gap. Now think in terms of the higher time frame chart. Obviously, I don't need to go to a daily chart because you know it's been going up, and it's been going up violently. Okay, so if one were to anticipate a run higher, how might that be utilized? How could you do that? Well, obviously, if we gap lower, like we did here, it's a discount opening range gap. That means we opened lower than where we settled at the previous day at 4:15 Eastern time. So opening lower down here, this would indicate that it's being suppressed. It's being offered at a discount price, and traders would usually expect it to go up, fill the gap, and then try to go lower. But you're trading against the higher time frame, freight train that's bullish. And if you're a brand new trader, hey, little girls, so that's the perils of live streaming. You can't edit that stuff out. The expectation of seeing that gap go up here, fill it, and go lower, that can be a trade, but not if it's against the higher time frame. So if you're trading against the higher time frame bullish scenario, if you're a brand new trader and you're trying to short a market like that, you have to be highly selective. But this opening gap here, what happens if you're in a primary buy program and the market's likely to go higher? Well, if it can overcome that gap, in other words, let's look at it like this. No, I'm not going to show gold and crude oil and Bitcoin and silver and all those other markets. We're just talking about this right now. Okay, I'm not trying to tickle everybody's fancy today. So that's the opening range gap. So the natural order is, okay, a premium or discount gap, it usually tries to fill the gap. Well, we get that. That goes without saying. Whether you're going to be shorting it or whether you're going to be going long, the gap closure takes place. But how would you use this if we overcome that gap like we did on this candlestick right there? The very next candle we open, we trade back down to it there. So now it's going to act as what? A discount array. Now, some of you may be watching this years from now and thinking, well, it's easy to talk about this in hindsight. Go look at the live streams where I'm calling every individual candlestick, and you'll see I have afforded myself the luxury and latitude to be able to talk like this. The students have been here for a while, it's not a problem for them because they see me do this. But the point is if you're trying to go long in a bull market and you have a discount gap like this and it overcomes it, the first time it trades down to it, guess what that is? That's the original first run into that range. If it's a bull market, it should act as discount sensitivity there. So it's going to use it as a means of like a trampoline. It's dropping down into it and then energetic run away from it. And we see that actually happen here. Okay. So with that, what happens if we miss that move? What happens if you don't get on board with that and you just want to know how much can this go? Well, you have to put a vertical line in the beginning because you're not going to be paying attention to time. You're going to be looking at every one of these little candlesticks and you'll get lost in the sauce. You'll get too close to the trees or too close to the forest to see the trees. and you won't be able to see, or did I say that right? Correct me on X if I said it right or wrong. The point is you're looking at the things that don't matter most, and the thing that matters most is time. So let's assume for a moment that hypothetically we expected the market to go higher today, and a lot of you probably did, and that's wonderful. It's great, but how long can it go up? Well, it starts its run here and works all the way up to the beginning of the lunch hour. Now, some of you might get frustrated with that because you're aware that it's 2 hours long. Don't call it a lunch hour. It's a New York lunch hour. And New Yorkers do things their own way. Okay? You ever been in New York? That's how it is. If you live in New York, that's how you are, aren't you? Give me a shout out in the comment section about how you are as a New Yorker. You're going to tell it like it is, aren't you? Well, at 11:30, that begins that 2 hour window where whatever took place in the morning session, it will roll against that. That's the lunch macro. So we have 10 o'clock here. This is, by definition, this is the best case scenario for a lunch macro. But as I taught the lunch macro, and I did a lot of this in Trader Roundup podcasts and my own Twitter spaces and talked about them, you want to use the very first one that you can come to when probabilities are shifted against you in terms of deep retracements, or if the market's really strong and it's gone up from the morning. Okay, how would you use that? Well, if you at 11:30 go to the left from there towards 10 o'clock, where's the first low you come to? This one. That just happens to have what? Relative equal lows. I liked this one here because it had a nice run up. It left this high intact and then deep retracement, and then the biggest run started right there. So I felt that that would be very likely to see it get traded to a level like this, where I think it might go to it, but I just want to be on the safe side because I am trading against the underlying higher time frame bias. If I'm wrong, it can violently shift against me to the upside. And because of that, I have to be wary about where good low hanging fruit, easy objectives to get out at. And I'll just use the moral victory, okay, the proverbial I was right type thing, okay, the cookie. Um, that it went to that level, but as I indicated on X a little while ago, at 29 minutes after 10, the low comes in at 29,595.50. That just so happens to be this candlestick at, if I can get my mouse on it right, at 26 minutes after 1, the low comes in at 29,595.25. I would have never been able to peel that off. They would have never let my order execute because I wouldn't have been just one tick below it. I would have been something like just below that low right there, simply because it's there. So experience taught me that while I think that's probable, and classically and scientifically, yes, it took out that low by one tick. It's too shallow, and it never would have afforded me the exit. Now, if I would have had my limit orders underneath that, or specifically that wick, because it's just to the left of it, because that would be like the relative equal lows scenario. So I would have something like a tick or two below that, and that would be I would be looking for a low escape on my short trade there. But because I'm against this higher time frame behemoth of a bull market run, because I'm against that, I'm not afraid to take the trade going short, but you should be afraid to take the short because you don't have the experience. And please allow me to say that, and it's not narcissism, it's not arrogance, it's not me being conceited. I'm not trying to talk down to any of you, but a lot of you want to find out. And you know what the first part of that is. Okay? Don't do that. Okay? You can study it, you can paper trade it, you can tape read it and say, okay, if I would have done this and done that, okay? And you need to do what I'm teaching you here today when you're looking for any old average sell off on a bullish day. If it were a day where we weren't in a primary bull market, I would have looked for that low. But because it's against the grain of the higher time frame, I have to be prudent and be responsible and say, okay, what's the highest probability? I know I can get these relative equal lows. I know I can do that. That's by itself, in and of itself, it's screaming that it wants to clean that up. So here's the science part of it, okay? And you all been wanting to see it. Opening range gap, okay? I'm going to pull out this super secret indicator. It's called the Fibonacci retracement, okay? Don't tell anybody. Don't talk about it. Don't post anything about this on X. Don't talk about it in your Discord channels, okay? Because if you do, what's going to happen is everybody's going to start using it and it won't work anymore. Oh, it's so fun. So if you look at the low, okay, which is going to be the opening price at 9:30, you missed me. Don't act like you didn't, okay? You know you did. So opening price up to the closing price, right there, okay? So now what we can do is we have two things here. We have time with the vertical lines, and then we have the Fibonacci that we can factor in. Now, if you have learned from me Forex trading, okay, I know that sounds weird coming out of my mouth now because I haven't talked about it much. And it's because the dollar index is stuck. Okay. When the dollar index loses its range on the daily chart, and then I'll be more inclined to talk about it. But right now, it's just too small of a move. It's not worth my time talking about it. And I don't want to entice any of you to look at doing anything with it because it's uneventful right now. But if you are a Forex trader, you can trade the exotics. That means don't trade dollar based pairs. Trade pairs that don't have the dollar in the name or the pair. And if you do that, you'll be fine. Okay. You'll catch all the movements that you're looking for. But right now, because the dollar's doing what it's doing, it's just going to be too much babysitting. And I don't want to have to be talking about it all the time. So there's that. If we look at this and you think, okay, if it's going to go higher, how many replications or standard deviations? This is the standard and deviates higher. That would be 1, 2, 3, 4, 5, 6, 7.5. Roughly. Okay. Why am I choosing 7.5? Because while watching price, when it was moving around, okay, we were entering this and measuring, okay, measuring the potential where price could reach for. When I was teaching the opening range gap, I told you that when we're in consolidations, when the market's likely just not to go anywhere in a hurry, what you can do is you can measure that opening range gap and get a measurement of 0.2 I'm sorry, 0.25 and 0.50. And what that is basically the same thing we do when we grade a PD array or a range or an inefficiency. Everything's graded because the market is algorithmic. I know it's probably something you never heard before, but the market is delivered algorithmically. This vertical line delineates when it's time to anticipate the setup. Why? Because we're entering the time window when it will likely form. Now, because it's 2 hours, it's 11:30 to 12:30. What do you think the setup's going to format in terms of time? It's going to be in the first hour, especially if it's been one-sided. Like all this movement here, one-sidedness. It just keeps getting pushed higher and higher and higher. All this buying pressure is overwhelming. So because it's gone higher, we limit our interest in this to the first hour of the lunch macro. Okay, well, let's go down here and add one more vertical line. Now it's getting too complicated now, right? It's too much. Can't handle it. So inside of the first hour of trading, between 11:30 and 12:30, during that first hour of the 2 hour lunch period that New York considers lunchtime, okay? If we see price when it enters here, what we'll do is we go through, and as soon as you get your opening range, you can rough eyeball it. Okay, what I do is I just take my thumb of my left hand, okay, and then and I'm going to try to describe this to you, but it probably won't be useful to you. But this is how I do it. Before I even pull the Fibonacci up, I hold my thumb out and I move it closer to the screen until it's just about the height of that opening range gap, or in this case, that box. So my left hand thumb, I'm pointing to the right. I'm holding my thumb tip out and I'm measuring that to get a rough idea how tall that is. And then I'll just move it up above to the low of my thumb is resting right here. So now I know from here to here is one standard deviation. Okay, so that's 1, I just do the same thing all the way up, and a rough eyeball, about anywhere between 6.5 to 7.5. So what I do is then I say, okay, well, I know it's entering the time here. So think like that multiplication table. What am I doing here? I'm going up. I'm going up the vertical axis. And then now, once I get up to the time, then I want to start moving over horizontally. And it unlocks, like the tumblers in a lock. Okay. Now, in and of itself, that's wonderful because we have it right before it, and we have the standard deviation of 8 next. Watch what happens when we do 8. Go! How about it, baby? How about it? Where are those bodies at? Talk to me about not picking a daily high. Talk to me. Talk to me, baby. I'm doing it on purpose. I'm just tossing that in there. The three-letter guy's not here. I'm just having fun with you. So here's that turning point that happens to be randomly in the first hour of the 2-hour lunch period. Okay. Now, my focus here, do me a favor real quick. If you're paying attention, if you're awake right now, if you're following me and you're on X, take a second over there and on X and say something flattering to the algo, not to me, something flattering to the algo that you see this right here and it's just unbelievably precise. Think about that. Now tell me, is that not beautiful? It's beautiful, isn't it? It's beautiful. Now watch right there. Okay. Gotta start listening for the helicopters. He's finally releasing it. We got to get over there and stop him. Man, it's so fun. Right here, what I wanted to see is I wanted to see if it can pierce that. I was going to try to get that as it ran up there. And it was just staying right there with that one. So on this candlestick, oh, oops. Let me see. There's that. Sorry. So what I was waiting for is I want to see it pump up there on that new candle, but it opened and only had a little bit of a wick there and didn't go higher than the previous one. Notice it did that, and then it sank down. When it dropped down in there, I already knew we're done. Why? Because of the time. I don't have much time before the close of that first hour. Because time's the most important thing. Why? Because algorithmically, the code, the sequence, the scripting of these markets, they follow a sequence. And everything's based on time, then price, period. They're not going for your stop loss. They're going for everyone's stop loss. Everyone's stop loss. Everybody gets a stop loss run. Everybody. You get a stop loss out. You get a stop loss out. You get stopped out. You get stopped out. Everybody gets a stop out. So when the price is going up like this, that's a bullish PD array if the market is bullish. But we're at the time of the day, first hour, that 2-hour lunch period, when it's all one-sided, the lunch macro is going to kick in. Relative equal lows. I love it. I want some more of it. Right there is my fill at the upper portion of that inversion fair value gap. Well, how did you know it's going to be inversion fair value gap? Because it was immediately on the next candle, unwilling to go to the previous candle's high and take that out. It goes right to the consequent correction of that level. Look at that. Let me get out of the way. Look at that. This is what I find fascinating the most in trading. The fact that the buying gets done to such a degree of precision where they no longer are interested to buy anything higher than that level. And then obviously it's almost like an invitation goes out, RSVI or RSVP, hey, short sellers, come on in here at this price and just start running lower because nobody's interested in buying. The market goes in here. Where's it go to? Oh, it just creates a little run right up to the high of that. Where's the support and resistance in that, fellas? Where's that at? Where's the renamed and rebranded stuff that's called support and resistance right there? Where's that rebranded stuff? Find that right there in anybody else's stuff. Okay? Because I'm not bragging. I'm telling you that this came from the Lord. And I'm not letting you steal his glory because it's his, not mine. Period. The market then starts to fall off precipitously and attacks that low right there, which was my first target of a minor sell side liquidity. And you can see right there, as I highlight, look right here, you'll see the little exit right there. You see that? Boom, look at that. That's so cool. First partial. And then because I've mapped that out and these levels here, I drew the fib between that low and that low right there. And the 50% is this line right there. That's event horizon. So if you're going to look for taking profits, especially in a situation like this where I'm against the higher time frame order flow, it's a big bullish run. Most people would be scared. I ain't, because the worst thing that happens, I'm going to get stopped out like any other trade. But you have this myth in your head that getting stopped out at all-time highs is much more painful than any other short that you would take. Think about what you're doing. That's what you're doing. And experience teaches you that that's no longer a reasonable fear, but it runs aggressively down through. And then we had this little area here I talked about. Well, not, I didn't talk about it, but I drew this out and I wanted to see it react off of that at a later time. But it took the profit below that. It took the profit at the event horizon. You see that right here? Let me get this guy's name out here. He's always shamelessly plugging his name. Look at that. Right there. And then ultimately getting down to my target. Watch right there. See that? There it is. Right below the relative equal lows. And then it runs aggressively lower, which is fine without me. It's okay. I don't know if the person that was posting to me on X was being funny or if he was making a comment that um, trading short all-time highs is a noob thing, or I didn't get it. So I just responded with this as a way of responding back. I didn't want to mute him, and I didn't want to say anything, have a conversation about it. I just said, well, I'm inspired now. They go out here and just short the daily high. So there it is. As you can see, it's scientific. It's not guesswork. All these things I've talked about in terms of time. I've talked about the characteristic of what the market will do when it goes straight up during the lunch macro. What's it going to do? During the lunch macro, it's going to pull back. And you want to see all those things form in the first hour. And the delivery can afford itself in the second hour. But the setup optimally forms in the first hour, that 2-hour lunch period. I know, it's good. I love it. I love it. You should have seen me the first time I saw it. I was bouncing around thinking to myself, man, there ain't no way this is going to work again. And it did. And then it did. And then it did. And then it just keeps on happening. It keeps on happening. It's almost like it's running on a time-based script. And that to me is fascinating, because how are the sellers and the buyers agreeing at that proper time? That to me is the mystery. How does all the buying and selling pressure that's caused by these buyers and sellers, how are they perfectly aligning themselves with the things I'm teaching you the market's going to do? See, it makes perfect sense when you address it in hindsight. It's wonderful. It's wonderful table talk time, water cooler conversation after it's already happened. But it's altogether something different, being able to do it live, real time, call it out there. This is what it's going to do. Be specific and use the same logic all the time. It repeats over and over and over and over and over again. It's not arrogance. It's not conceitedness. It's not narcissism. You are being trained to become more than an overcomer. And that's scripture. And it's not because of me, it's because of him. I'm just the talking point. I'm the instrument. Okay. That's it. So it's interesting how they went down there and took that low right there by one tick. And then it completed the lunch macro and it ran all the way back up to that inversion fair value gap right there. That's incredible. And look at that sell off right there. What makes that so good? Two things. Number one, it doesn't need to take that liquidity. It's pulling up during the opening range for 2 o'clock. And it's not only a premium array here, but it's also a breaker. See that? Boom. Okay. And then look what it did down here. It came down and used those pools of liquidity I outlined, and they were targets. And then now what have we done? It's in slop. I don't want to trade this. Would you look at this and say, well, I feel a little bit, you know, encouraged to go short or go long here? I wouldn't touch it right now. I wouldn't touch it. And that's That's just my advice. I wouldn't touch it where it's at right now. Let it do something overnight and then go in tomorrow morning pre-market session, 7 o'clock in the morning to 9 o'clock ish, and look for something there. Let them have the overnight. Let them have it. Let them have all that. And then tomorrow morning, everything will be fine. You'll have a good technical day tomorrow, and it'll be fun. You'll have a wonderful Friday session, and you can sail off in the weekend happy and sugar coated like I feel today. And I just had fun sharing this with y'all. If you learned something today, if you felt like you got something, if not, if anything, entertained, just let me know in the comment section. Okay. But everything I showed you here in terms of time, I've already talked about that stuff. But how to use the standard deviations of the opening range gap and then time, it affords you a great deal of precision that no other discipline, no other way of trading, no other form of archaic technical analysis, and I'm using the quotations with my fingers right now, technical analysis stuff that I supposedly rebranded, you'll never find this anywhere else. It's nowhere else. Nowhere else. And I'm going to encourage you to do these types of things each day. Study them. Even if you can't make it line up in the beginning because it's going to feel cumbersome in the beginning, keep doing it. Keep doing it. And what will happen is one day where everything is perfectly clear to you because of your experience level, not because it finally works. It's because you're looking at it with the right perspective. You've been doing it enough. You know what you're looking for. And that's all you're seeing here today.